Hey guys, John Paulamy here, Actionable Intelligence. Today's Thursday, August 27th, 2020, and I wanted to do an update on the Jay Powell Jackson Hole comments because it's kind of a good part two to my last video when I talked about this mean reversion. This was the chart that I put up on the last video where I showed how out of favor energy was and showing you how there's such a discrepancy between tech and energy. Tech is riding high right now. Energy is low. As a matter of fact, current situation in the S&P 500, you basically have 4 or 5 stocks dominating the market, the FANG stocks. And energy now is basically in the S&P only accounts for 2.5% of the total S&P. That's how out of favor energy is right now. And one thing I didn't get into, I talked about this in the previous video, but the one thing I didn't get into when I talked about this mean reversion that I expect is what would be the catalyst for that mean reversion? What would cause it to move the other way? Would cause tech to go down and cause energy and other commodities and resource stocks, gold, and I also throw cryptocurrencies into that basket. What's going to cause them to go up off the bottom and for tech to roll over? And I think we may have our catalyst. We may know. I was noodling this. I've been thinking about it for a while. I've been talking about it in the videos, but now we're seeing the policy, right? You know, we go back and talk about how COVID was the pin that pricked the bubble that we had anyways. We had a huge debt bubble. I've been talking about it since I've had this video channel. And COVID was the lance of that particular boil. And so now, with all of this money creation going on, we've had this, sugar high. The markets have ran, concentrated in just a few stocks, and a lot of the resource stocks and things that I'm interested in, or things that I think that are undervalued, have just got left behind. But I think that changes now. And why do I say that? I say that because the central bank is doing exactly what I thought it would end up doing. And I'm not the only one. This is not some new revelation. I mean, there's been a lot of people out there yelling about this for years. I mean, but you have to get your timing more or less correct, right? A broken clock is right twice a day. I mean, you've had people like Peter Schiff and these people that have been on there for decades. I haven't been around that long saying this, but now I think that the Federal Reserve has basically come out and said what it's going to do. They've basically adopted central planning. They're going to adopt a new inflation mandate, basically. They're going to let inflation run hot. Now, we speculated that this was what they were going to do. They had discussed it. There had been people giving speeches, people that were Fed speak, but Jay Powell's basically come out and said that now that long anticipated, the Federal Reserve has Chairman delivered a new approach to monetary policy for the central bank. It will tolerate inflation rising above 2% for short periods of time. Well, that's interesting. So Jay Powell and the rest of the mandarins at the Federal Reserve know exactly how much inflation is needed in the economy. They know the exact amount of interest rates. They know exactly how long they can let things run. Now, I find it interesting because we've seen this before. People say, well, John, there's money printing has happened before. It's happened in Japan. It's happened in these other places. But there wasn't any inflation. In 2008, people said there was going to be hyperinflation. And that's exactly right. We've had inflation in financial assets. However, the reason why is because we haven't had too much inflation in real goods or prices increasing in real goods is because the mechanism to transmit the money creation to real goods and services was not in place. The mechanism was in place to transmit the money creation into a, shall we say, rise in financial assets, which would lead to a wealth effect. That was the theory. Now, I mean, look what we're dealing with. We're dealing with riots. We're dealing with displaced people, 30 million people unemployed. There's going to be infrastructure. There's going to be stimulus, depending on who gets elected. There's going to be a Green New Deal or a big infrastructure project on a huge scale, and it will have to be paid for. on top of all the debt we already have. And so we have seen this before, and I will show this in another slide. But what I want to talk about is a couple of things. Now, I'm going to talk intellectually and from my libertarian leanings, if you will. And I will make this comment in the second bullet point. What makes these arrogant buffoons at the Fed think they know exactly the right amount of inflation or the right interest rate to set? They're so confident in their abilities that they can push the buttons in the right sequence and move the levers, the right lever to the right, and they'll get it just right, and it won't get away from them. Well, I do not agree with that. I think that you can't get a little bit of pregnant, and you can't have a little bit of inflation. And I think it's arrogant and beyond the pale that these people think they can do that. And I think it's also unbelievable that Congress allows it and that the media goes along with this. But this is part of this whole oligarchy and part of this whole, thing where, this big club, as George Carlin said, that you're not in, okay? This isn't all being done for your benefit. But this is right out of Soviet Gosplan central planning. We know the exact amount of inflation that can be out there, and we can control it, and we can bring it back in. Well, the thing about inflations in money creation and hyperinflations are that once you cross the Rubicon, I talked about this in a video several months ago, you can't go back. You can't stop printing money, because if you do, you have a deflationary collapse. You have a debt super bubble. You are basically creating money out of thin air to keep that reckoning, that day of reckoning, if you will, from happening, that debt defaulting. Okay, that's why they're in there buying bond ETFs. That's why, Apple brought a bond offering to market. It didn't need the money. It's sitting on $200 billion in cash, and yet the Federal Reserve is in there through the special purpose vehicles buying that debt. Okay, it's just a big sham. So all of my fairness and libertarian instincts and morals and ethics say they can't do this. But what's their option? Now, the last couple debt cycles, we've transmitted all of this new money creation into a tremendous rises in financial assets. So it's the investing class, the Sharpies, the hedge funds, they've made out. But I think they're going to have to now transmit that money directly to Main Street. And you're going to see it, I think, regardless of who's elected, regardless of if it's Biden or Trump or Democrats, Republicans, they're going to spend money. Not only that, they understand the situation. They're not as dumb as people think they are, okay, at the Fed. They have a lot of PhDs. They have a lot of history. They've written a lot of papers. We've been here before. And what do I mean by that? We have so much debt now, government debt, corporate debt, personal debt. It's not going to be paid back. We have tremendous amounts of unfunded obligations, Social Security, Medicare, state pensions. All this stuff is going to be, in a democracy, people are going to demand that these things are paid. And we have history here. We have exchanges between Congressman Ron Paul and Chairman Bernanke and Chairman Greenspan, especially Greenspan. I'll have to find the clip and play it on the next video, but, Congressman Paul asked him about this. How do you intend to pay these obligations? They cannot be paid. He said they will be paid because we have the reserve currency. It was straight out of Stephanie Kelton's book 25 years ago, this exchange. And Greenspan said, we can pay it, but I do not guarantee the value of the currency that it's paid in. So that tells you what you need to know, okay? But they don't have a choice. And so what they're doing, what we're going to see is a prolonged era of negative interest rates. And I've explained this before. What are negative interest rates? You're going to have rates kept very low. You're going to have inflation run above the norm, okay? That's what they're telling you. And you're going to have a negative interest rate environment. That means if you're a bondholder, they used to call bonds in the 70s, when there was a lot of inflation, certificates of confiscation, because they confiscated your wealth. If you had an inflation rate of 10% and you were getting 5% on a government bond, you were losing 5% of your purchasing power. And this is what most people do not understand about how the government deals with these huge debts. They basically steal wealth from people via these inflationary policies and these negative interest rates. Now, they've done it before. World War II was a basically civilizational conflict. Some people have described it. The fascist regime in Nazi Germany, the Japanese Empire, the sneak attack of Pearl Harbor, December 7th, a day that will live in infamy. We remember all that. The patriotism, the war bonds, people scrimping and saving, turning their pots and pans in to be melted down. But this is what happened. We created a tremendous, they didn't have the money to pay for this. We were not only funding our own war effort, we were building materials and giving it to the Soviet Union through Lend-Lease programs, the UK, building tanks and giving to them. You know, we were the arsenal of democracy, but somebody has to pay for it. It's not for free. So the government went into a tremendous amount of debt. I mean, this is a history of debt, a chart that I got off, from the Atlantic website, from an article. But it goes, this shows the history of the debt. And basically, we have two numbers here. You have the, what we're concerned about is percentage of the debt, of public debt as a percentage of GDP. And it maxed out in World War II at 112%. And you see it went all the way up, and then it came all the way down. And I'm reading some papers now. The Fed has written about this, how they did this, how the government was able to get the debt lowered as a percentage of GDP. And what they did is that they artificially lowered interest rates, held them there for a long period of time, and let inflation run at a little bit, at a higher rate for a period of time, and basically inflated away the debt. And you see that over time, we basically brought the level of public debt as a percentage of GDP down to less than 30% by the time that the Reagan administration came into office. And then we've, during the Reagan administration, we started increasing debt again. George Bush, Clinton, Obama, all of them, we've done all that, right? So we've basically doubled the debt every year. Now, okay, who cares, right? But look at our current situation. I mean, this chart only goes to like 2005, right? But look at our current situation, okay? Let's pick it up. 2005, we were running 50, 60. Okay, we're at the last recession in 2008. The debt basically took off, right? We went from about 60-something% of GDP to, when we came out of the recession, over 80%. It was a 33% increase in a few years. And now you see the debt hasn't stopped increasing. It kind of leveled off, but we've kind of still been going up. Now we're having the next surge upwards, and we're currently at 107% of GDP. Now, a lot of economists will say that once you get to these levels of debt as a percentage of GDP, you really stifle your economy. Your ability to grow, your ability to facilitate growth in the economy is really constricted. So I think what a lot of this has to do with is the fact that they know this. They're not stupid. They know what they did before. And I'm going to expand on that in another video. I'm going to actually go through those papers and show you. It's very dry reading. It's very hard to parse. But I'm going to try to parse the mechanism that the government used to basically steal wealth from people and get the debt down. They didn't raise taxes on people. They just let the inflation rate run and kept interest rates, artificially confiscated people's wealth. You can see where this scheme is going. They're going to keep rates down. And people say, well, John, the bond vigilantes won't do that. Well, there's not going to be any bond vigilantes if the Fed comes in and buys all the debt like they do in Japan, okay? They can keep the rates as low as they want because there won't be any bond vigilantes. But there is an aha moment, and it's the currency, okay? You can pull this off. The bond vigilantes won't exist. Interest rates won't go up as you print more money and as you run a higher inflation rate. But the currency will begin to reflect this debasement. And that's what we're beginning to see. And that's why you're seeing gold recently over 2,000 and still, notwithstanding the recent pullback, why you're seeing now breakouts in the grains, why you're seeing copper over $3 or close to $3, why you're seeing all of these markets starting to move, why you see lumber up over 100%, okay? You cannot increase the amount of goods and services as fast as you can the currency. So it's more complicated than that. It's more than we can talk about in a 10-minute, 15-minute video. And I'm not even the smartest tool in the shed to explain this. I'm going to be looking for some people to interview that can explain it better than me. But this is what I think is basically going to happen. They are going to let inflate, you know, and the idea is going to be, well, you know, to get employment back, and because of COVID, they have the perfect cover story now. So they can do what they've wanted to do all along, which is create inflation. That's what central banks do. They create inflation. And now they can do it. They have a pretext because of the economic situation in the country. And regardless of what administration, there's no physical responsibility. No one talks about reining in the deficit. Name a deficit hawk anywhere in the government. There isn't one. In the Congress, certainly not Orange Man, and certainly not Biden. So this is a way out. And so I think it's going to be a prolonged decade or more of higher inflation. And I think, you know, back at this time, what scares me about this is back here you had, even though, I mean, government officials are pretty much bed bugs, but they kind of understood and they knew what they were doing. Now you're handing the keys over to a whole group of nitwits in these Congresses. You don't know what you're going to get. There's all kinds of simps running around, simpletons, morons, half-wits, and they come up with these schemes, and the Fed will be hard-pressed. They'll just replace Powell and other people with people like, you know, you could see a Stephanie Kelton in there, and, you know, they'll just do what they think they need to do. So what I'm trying to tell you is that, you know, they have been talking about this for a while. They have been hinting at it, and now they have the cover. Now they're going to do it. There's a change here in the Fed's methodology that they have formally stated. So, I mean, literally the guy has driven over to your house, knocked on the door, sat down, and had coffee with you until you said, hey, over the next decade or so, there's going to be higher inflation, a lower dollar, and that is not going to be good for the current darlings of the stock market. The Nifty 50 stocks, the new 5 or 6, you know, tech titans do not do well, I think, in a highly inflationary environment. But I do think that real assets, oil and gas, commodities, resources, they will do well. That's my opinion, and I think this is a pivotal day and something that will go down as a change in policy. And do not be mistaken. These people know exactly what they're doing, and you have to, we really have to understand it, because it's going to be, if you make the wrong choice here, you know, and think that all these things are just going to keep going to the moon, you know, everything's setting up for the mean reversion. We're you know, sediment, the overvaluation of tech stocks, the undervaluation of resource stocks and energy, and this alligator jaw, I think, is getting ready to snap shut. You do not want to have your head in here, let's put it that way. You better be on the right side of this thing. All right, guys, that's it for this video. Appreciate it. Hit me up in the comments. Like I said, we got a lot more work to do on this to really understand it, but I wanted to talk about this today quickly. You know, the prior video was about this mean reversion, and I wanted to try to explain a little bit of what I thought the catalyst would be, and I think we've seen it now come to the surface. All right, guys, thanks a lot. We'll talk to you next time.